Welcome to another episode of the Michael Yardney podcast. What's ahead for our housing markets in 2024? Even in the short couple of weeks of this year already, some of the forecasts have changed. It now seems inflation's been tamed and interest rates have peaked. And many market commentators, many property economists, they're already updating their forecasts for the coming year. And while the media loves sharing these forecasts with anyone who's prepared to listen, of course the longer-term outlook's much more important for investors as it better aligns with what you should be thinking about with your investment horizons are. In my mind, investors should be thinking about where the markets are going to be in 10 years' time rather than where interest rates are going to be in 6 months' time. However, in today's podcast, I'm going to discuss some of the dominant influences on our housing markets for this coming year, in 2024, with independent financial advisor Stuart Wemyss, founder of Prosolution Private Clients. So, whether you're an experienced investor or just starting out, this episode's packed with insights that when you listen to Stuart, you'll see they're data-driven, they're evidence-based, so they should help you make more informed decisions. So, let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Stuart.
Hey, Michael. Great to be back with you again.
Now, Stuart, it's not surprising that this time of the year, and we're already into February, there's so many so-called property experts are giving their opinion on what's ahead for our markets in 2024. Now, I know you've already jumped into the ring with your thoughts, but unlike many, I like the fact that you're bringing a level of perspective, many decades of investment experience and on-the-ground experience, so you're offering realistic expectations. So I'd like to ask you some questions about your recent blog, and I love listening to your podcast that's, well, it used to come out once a week, and now you're doing it a little bit more often, your Investopoly podcast, and your blog every Wednesday, where you gave some thoughts about the property outlook for 2024. But Stuart, maybe we should start with a disclaimer. You mentioned in your article and your podcast that investors really shouldn't have a short-term horizon. What's going to happen in 2024? They really should be looking more at the long term.
What's happening to the property market or will happen to the property market this year, Michael, makes for a really interesting dinner conversation or debate. And I'm equally interested as well, but what interests us doesn't necessarily help inform our investment decisions. So kind of what I'm saying there is if we're long-term investors, who cares what happens this year or next? You know, if I went and bought a property yesterday and my intention most likely is to hold that property for many decades, maybe 20 or 30 years. So I would it'd be nice if the property market had a great year, a great sort of bull run, and I accumulate a bit of equity in that new purchase. That'd be lovely. But equally, it's not going to disrupt the value of that investment or the effectiveness of that investment if we have a terrible year. You know, it's not about short-term gains. It's really about longer-term gains.
Well, that's one of the themes we always say. But recently I was requested by a media outlet, what are the hotspots for 2024? And I hate those answers. But you actually have to help the media, because if you don't, they're not going to ask you next time. And so there's a lot of that around. But I find it much better to have long-term expectations than short-term forecasts, Stuart.
Yeah, I totally agree. And so for people, particularly first-time investors, because I think seasoned investors have kind of learnt this through experience, but for first-time investors, probably the best thing you can do is ignore short-term forecasts, which might be actually stop listening to this episode. I'm not saying that, of course, Michael, but really take them in context or a grain of salt. What you want to do is try and consume as many long-term forecasts and focus on the longer-term outcomes as you possibly can. And there's probably two exceptions to that. If you're looking at selling a property in 2024, and potentially just a little bit if you're looking at buying a property in 2024. You know, you ask a real estate agent, when is the best time to buy a property? Of course, they're going to say in this market. But it's true that, you know, different markets are easier to operate in terms of as a purchaser. And so it is important to think about, well, where is the market? Is it a balanced market? Is it a buyer's market? Is it a seller's market?
Sure, it's not nice when you buy a property and then the market starts to go down a little bit, even though 10 years, 15 years later, it really doesn't make that much difference. So what do you think are going to be the main influences of our property markets in 2024?
100% interest rates and inflation, or maybe I should say it in the other order, the reverse order, inflation and interest rates. So really that's the big question that the markets, share markets and property markets, all investment markets are grappling with and have grappled with really probably for the last 12 months. And I think will continue to grapple with for at least another 6 months. And that's as true as today the Federal Reserve Chairman was on 60 Minutes a couple of days ago talking about interest rates and their expectations around interest rates. And he was trying to cool the market to say, look, the market's contemplating whether there's going to be an interest rate cut in the US in March. And he's sort of saying, well, forget about it. March is too early. So you're going to get a lot of jawboning, I think, from central banks to try and cool the market. You've got bond yields rising and falling. They're pretty volatile. One week the market's view is interest rates under control inflation is under control and interest rates are going to come down. The next week, it's, interest rates are going to remain at this level for a lot longer than we expect and inflation might be a bit persistent. And so it ebbs and flows between kind of those two outlooks. And the same impact affects sentiment in property markets as well. So, what will happen to inflation? Will interest rates have to stay at this level for a longer period of time? I think we've probably got our heads around we're at the peak. It's now just where will interest rates go from here and how persistent will inflation be and will inflation kind of tick up? When we learned that the Wharfie's got a 23% pay increase to be pushed through over the next 4 years. Now that landing a container then on the docks in Australia is going to cost a lot more. There's no doubt that consumers are, as a result, going to pay a higher price for those cost increases. So they're the sorts of things that kind of worry economists of whether there's going to be this sort of wage price spiral where unions are, rightly so, representing their members saying we've got this cost of living crisis. It's harder for them to make ends meet. We need a pay rise. And then the unions are successful in negotiating one, but unfortunately that then flows through to prices. That's our risk.
Well, the market hates uncertainty, doesn't it? And last year there was a lot of uncertainty. There was the uncertainty about, are we going to have a recession? Are we going to have a mortgage cliff? What's going to happen to interest rates? How high is inflation going to go? This year the uncertainties are different. But if you look back, most years things are uncertain. And then all of a sudden things change and buyer and seller sentiment change. And I think we're probably going to have a year of two halves when buyers and sellers realise that we've reached the peak of interest rates, which I believe we have, and that inflation's under control. Eventually, consumer confidence is going to return. And if you just look back in previous cycles, Stuart, seller sentiment, buyer sentiment changed quickly. In fact, I think buyer sentiment changes before seller sentiment, and that's what's already happening. We're finding at Metropole lots more home buyers, but particularly investors keen to get in. They're seeing a window of opportunity to get in before the crowd does. And when you look back at previous cycles, the market really did turn rapidly. Look, after COVID, what was it, 2020? Boy, it turned quickly. 2019, after that election, loss of the federal election of the Labor Party, where people were concerned they were going to change the tax laws, markets turn quickly, don't they?
Oh, they can absolutely change on a dime. It's something I was talking through 2020, 21 and so forth in terms of interest rates where, people were sort of forecasting, well, maybe interest rates will stay at sort of zero-ish levels for the next decade. I mean, they did that in Japan, of course, for about 20 years. They were at zero and still are close to zero. So it's not impossible, but equally, interest rates tend to change very quickly, interest rate settings. If you have a look back over the last, 30, 40 years, they've increased quickly and typically decreased quickly as well. So they can change very quickly. Economists have coined this term called immaculate disinflation. And what it means is the ability of central banks to tame inflation without causing a recession. And at the moment, it looks like immaculate disinflation in that the labour markets around the world are pretty strong, particularly in the US and Australia. Inflation looks like it's coming down. So it's heading in the right direction. And it doesn't, at this point, seem like we're going to experience any kind of recession or economic hardship as a result of the higher interest rates. And so it almost looks too good to be true at this stage. So I think also the market's trying to reconcile that as well, is hang on, is it really going to end so well? Have they really unwound this inflation and put the inflation genie back in the bottle without actually harming too many people along the way? That's the kind of the big question mark, I guess. But as soon as it changes, it'll change. And our conversations, Michael, will go from, there's a lot of uncertainty out there to now everyone wants to get into the property market all at once. And you and I have seen it plenty of times before. It literally can change in the space of a couple of weeks where you've got kind of lukewarm sentiment around investing in property, and then 2 weeks later, people are bullish. I don't care, I'm happy to overpay to get into the market. I think it's going to run away. So it does change very quickly.
FOMO. Well, one of the things that has kept our housing markets resilient last year was the lack of stock. Vendors didn't put their properties on the market. And there's two types of vendors. There's discretionary vendors, those who can choose to upgrade, downgrade, get into the market. And of course, there's always those motivated vendors because of death or family circumstances or mortgage problems. But many discretionary vendors last year, Stuart, well, they didn't sell up. I think there were a couple of reasons behind it. First of all, they weren't even sure if they were to sell, where would they move? How could they move? Is there much else to buy? It's almost a self-perpetuating thing. And the market, the commentators are currently saying, well, this year more vendors are going to come back onto the market. And by doing that, they're going to bring on more stock. And that's going to hold back property values. They're not going to go up because there's more stock. I have a slightly different view. Forget property investors who don't bring a trade-in in. Most sellers are also buyers. They're upgrading, they're right-sizing, other than first-home buyers. So, yes, I think vendors are going to come back, but I also see that means there's also going to be more buyers out there.
It's the chicken or the egg, isn't it, really? Which happens first? Is it increase in buyer demand or increase in supply? I would say it's increase in buyer demand will precipitate an increase in supply. That is, more discretionary vendors saying, okay, the market is actually pretty hot, it's recovering, let's sell, let's put it on the market. I think the buyer demand will increase first because I think vendors tend to think about, is it a good market to sell in? And if a house down the road has been for sale and hasn't attracted too many people through the open, and there hasn't been a lot of demand, typically people, if they're, as I said, discretionary vendors, they're under no compulsion to sell within a particular period of time. In that situation, people are going to say, look, let's sell next year. Let's not do it this year. Whereas if they walk down the street and there's a line out the door in terms of the home open of people trying to get through that property, that just encourages them to sell. So, but like we said, the buyer demand piece can change very quickly, and we don't necessarily need interest rates to start falling. We just need a consensus that they will fall, and by how much and what time. And that gives people some confidence around borrowing costs and how much it's going to cost to upgrade or hold an investment property or implement their plans.
Well, you mentioned borrowing costs. One of the services that you provide your clients at Prosolution Private Clients is mortgage broking, much more than mortgage broking, but you do give finance strategy. How do you see the borrowing situation playing out in 2024?
It's a real challenge, Michael. I would argue that borrowing capacity is the tightest it's ever been, probably since banking deregulation in the mid-'80s. And I think if you go back further, or go back beyond that, it's not really that relevant. And the reason for that is that about 5 to 7 years ago, APRA started tightening the way that loans were assessed, particularly focusing on looking at an applicant's spending patterns and living expenses, actual living expenses, as opposed to using a very low benchmark. So that happened 5-7 years ago. And then obviously the rate hikes over the last 18 or so months have had a big impact on borrowing capacity as well. So those two things together have never really occurred together at the same time previously over the last 20 or 30 years. So that's why it's the tightest it's ever been. And the problem with that is that for, high income borrowers, it's not a big deal. They've still got enough borrowing capacity to do whatever they want to do. But what it locks out people with lower incomes out of the borrowing market, which only exacerbates wealth inequality, which isn't really desirable, I think, for an economy. So borrowing capacity needs to normalise at some point, but I can't see APRA making too many changes. I don't think they'll make any changes this year. And really, we just need to wait for interest rates to come down for borrowing capacity to improve. So it's still going to be a challenge, but getting a good broker, making sure you're using the right lender, making sure the broker's really experienced so that they can... there's two things you need to help a client understand. How much can they borrow and how much should they borrow? In a market like this, which is quite unique, sometimes or more often, how much should you borrow is more than how much can you borrow, because the banks are ultra conservative at the moment, whereas in a normal market, that's never the case. So if we've got a client, we think, they can easily afford to borrow $1 million to go and invest, for example, then it's really about finding a lender that's going to accommodate that and making sure that you put the application together to show the strength, to show why you believe this borrower can afford it. And having a good broker in your corner will really help you do that. And I think that's critical in this market because as you say, Michael, property investing is just, what is it? Finance with a few houses.
Game of finance with some houses thrown in the middle. Now, a recent report from Nerida Conisbee, the chief economist of Ray White, showed that the more expensive houses and the more expensive apartments outperformed the average over the last decade. Now, sure, they're more volatile, and I'm not saying the most expensive house in Vaucluse or Toorak is a good investment, but I think it's a sign that the markets are going to remain fragmented. The rising cost of living, rising borrowing costs is not going to affect some people as much as others. And so I see this year people who've already got a lot of equity in their home and some are going to downsize or not going to borrow as much, they're not going to be as affected by this. While at the cheaper end of the market, people who are living week to week, people who are hurting more with the cost of living rises or rent rises, they're going to suffer a bit more. I think also a trend is the bank of mum and dad, Stuart, where the wealth transfer is happening with a warm hand nowadays. More and more people are helping their kids and grandkids get into the markets.
And I think rising rents will only fuel that even further, Michael, as you can imagine. And it's a common conversation where you have young children that are now young adults going to uni. They might hopefully move out of home and go and rent somewhere. But instead of paying $600 a week to go and rent a two-bedroom apartment or whatever it might be, and if parents have to, make a partial contribution to funding that rental expense, parents might start to think, oh, hang on, well, at some point it's going to be almost as cheap to buy as it is to rent. And so maybe I can help my child get into the property market, which most parents are very keen and to try and help them in the right way to do that. But the rising rents, I think, will have, whether it's this year or next, I'm not entirely sure, but the more rents rise, the more enticing it is to be an owner rather than a renter. And particularly if you're looking at wealth transfer, if you're thinking about how will my child get into the property market, that's going to become a stronger theme, I think, over the coming couple of years.
Well, I think we both agree that at the end of the year, property values in general will be higher than now, but they're probably going to rise more slowly. I read in your blog that you believe Perth's going to be a standout market in 2024 like it was last year, and I agree with that. One of my concerns at the moment is, having spoken to a common client and friend that we both have who's in the industry in Perth, he's seeing a lot of buyers agents from the East Coast buy property sight unseen, 20-30% higher values, paying a lot more than the market would believe is correct in Perth at the moment, just because it seems cheaper. So I'd be very cautious about that. I think Brisbane's also going to do well this year. Conversely, that Melbourne, where we both live, we've spoken about it before, it has underperformed. And while there clearly is inherent built-in equity, because you can't replace the apartments at what the market values are today or the houses. It's still going to have some trouble, and we can't blame COVID, and I'm not even sure we can blame Dan Andrews anymore. Why? What's going on with the Melbourne property market?
I've been thinking a lot about this, Michael, even over the Christmas, New Year's break. It sounds a bit sad, but my wife and I went away for about a week or so up to Queensland to sit in the sun, and admittedly, I was sitting there thinking about this very, very issue. There's a lot of things that impact the property market in Australia that are national, that are national issues like immigration, interest rates, unemployment, supply, all these sorts of things. So you can't, that doesn't really inform us why different markets move at different levels. The only thing that is different is the level of debt that Victoria has, which is a lot more than other states, and that all states generate most of their income from the property market in the form of land tax and stamp duties. And then the GST revenue they get from the federal government is a large portion as well, but less than 50%. There's a concern there, I guess, that property investors might have to say, well, do I want to invest in Victoria because the pressure is going to be on raising taxes, as opposed to WA, for example, that has next to no debt. Then also you've got to think about then the government. Is it predictable? Is it reliable? Do they consult industry before they make any changes? Well, you wouldn't tick any of those boxes when thinking about the Victorian government over the last 10 or so years. Now, I want to be apolitical about it. It's not about Labor versus Liberal, any of that sort of stuff. It's really about how or what could it be. So I don't know what the answer is, but they're my best guesses of why Melbourne's underperforming and may continue to do so. And I want to touch also, Michael, on your point around interstate buyers agents acting in a market that they don't have any experience in. And you'll recall, Michael, probably about 15 years ago, there was a lot of buyers agents going up to Brisbane buying apartments in Brisbane. And it was common that, people that lived in Brisbane just thought these people coming from, or these buyers that reside in Sydney and Melbourne are just stupid. They're paying $100,000, $150,000 too much for these apartments. And they were really just flogging them off to interstate buyers. And what happened there is, and I met a few of these clients along the way after this. Of course, we would never have recommended such a transaction, but they crystallised losses of $100,000, $150,000. Like the apartments were totally overvalued. It's a big red flag. If I'm going to pay a buyer's agent, I want them to be an expert in the geographical area that they're operating in. If they've got no experience, then what am I paying for? I'm just paying for someone to complete a transaction. We don't need to pay a lot of money in order to do that. So I think it's a big
They say I've got all the data. The data is only half the story, isn't it?
Yeah. It's a nonsense to think that you can analyse a location without understanding. I mean, property is part art, part science. I know we've spoken about that previously. It's a good warning sign. It happens in every buoyant market, where buyers agents flock to a particular area because there's a bit of stock and it's easy to sell and Perth's cheap, et cetera, et cetera. But you just got to be very careful.
Well, before we finish off on the 2024 year, you also wrote a blog earlier this year about some of the lessons from 2023. And one of them, I guess a theme we've spoken about over and over again, is have a long-term focus. If you're not planning to hold your property for 10, 20, 30 years, don't even get into the property market at the moment. And so you shouldn't make 30-year investment decisions on the last 30 minutes of news. But I think what you also wrote in that blog was, if you've got the right strategy, because you actually said nothing warrants a change in your investments or your strategy, I'd actually just qualify that a little bit, as long as they're the correct investments, quality properties, or the right strategy.
Yeah, that's right. It's tempting when markets change or outlooks change and the general sentiment is, in a certain direction, it's really difficult to drown that out and not think that because this has changed or this expectations change, I should change something in my investment strategy, investment assets or so forth. It's a challenging thing to deal with. And the example that I gave was at the beginning of 2023, calendar 2023, the general consensus amongst almost all Australian and global economists was that the US would go into recession. it was almost a fait accompli. Like it was going to happen. It's just about when and how deep. That was the question. And so what I contemplated at that time is, should we make any changes to our investment portfolios as a result of the heightened risk of recession? Anyway, I really thought deeply about it and resisted the temptation to make any changes on the basis that who cares if there's a recession because we're long-term investors and it all work out at the end. You might not know when the market will drop, but you certainly don't know when the market will recover, and you've got to be invested to enjoy that uplift. And so, as we know, last year was a pretty stellar year in global equities, about 20+%. And so, luckily, we didn't make any changes to portfolios. But that really reminded me that really you've got to drown all this noise out. Interest rates, inflation, unemployment, changes to immigration. We can talk about all these things ad nauseum, but really they don't mean anything. In the long run, it's about supply and demand. It's about land value. It's about fundamentals. And so if you've ticked all those fundamentals off when you first made that acquisition, that property acquisition, relax, just stick with it. Even if, for example, you're thinking, well, Melbourne's going to underperform. It won't underperform over the next 10 years. It might underperform over the next 10 months. So it's not really relevant. Don't worry about it. Just get back to you living your life, enjoying your life, and let your property assets do their thing.
I think that's important to remind people that even though we said we're a bit uncertain about the Melbourne property market in the short term, you also wrote a great blog saying that the Melbourne median house price is likely to surpass $2 million by 2032. It's Australia's largest capital city now because they changed the boundaries a little bit a while ago to include Melton. It's got a very significant percentage of the overseas migration coming here. And Stuart, if you think about those, we know those migrants initially become tenants for 2, 3, 4, 5 years till they find their ground, find where they want to live. But that means there's a whole pool of potential buyers sitting in rental properties at the moment to hold up our property markets. Our economy is robust, our population is going to keep growing. So I think that gives Melbourne a very strong medium to long-term outlook.
And we know mean reversion always kicks in, Michael. So returns will always revert to the mean, which means that if we're investing in a market that has had a period of underperformance for a few years, most likely the next decade's going to be above average. And so we know that. We know Melbourne and Sydney don't perform dissimilarly over time. Now, they might not grow in unison. Each market will have its day in the sun. But it also means that, if Melbourne has underperformed over the last few years or 5 years, in fact, it's underperformed over 5 to 7 years compared to Sydney, well, we know the next 7+ years are most likely, or almost certainly, going to be better than average. So we're willing to let that mean reversion kick in as well and do most of the heavy lifting.
Great. So in summary, if your financial circumstances are solid, you've got a good job and your finances are right, it's a good time in the market to find the right asset, one that you're going to be able to hold in the long term. And then when you look back, you're going to think, gee, that was pretty cheap.
Yes, in the long run, property always looks cheap. In the day that you buy, on the day that you buy it, it looks insanely expensive.
Yeah, sure. So, Stuart, before we finish off, your team at Prosolution Private Clients has a number of services it helps clients with. I'm going to leave a link in the show notes to that, as well as to your podcast, which I'd commend people listen to as well. Even though we discuss similar things here, you do a monologue where you explain your thoughts, which I believe are very relevant. But maybe just tell us quickly what your team at Prosolution do.
Sure, Michael, because a lot of financial decisions are multifaceted, and investing in property is a perfect example. You've got borrowing capacity, loan structure, taxation, cash flow, financial planning, how does the property fit into the longer term strategy, all those sorts of things. Because those decisions are multifaceted, we believe that taking a holistic approach gives us the greatest ability to harness the most amount of value for clients, so that we are thinking about all the consequences of a particular financial decision. So that means our team of mortgage brokers, accountants, financial advisors sit around a table, talk about our clients, formulate a strategy, and then help navigate and implement that strategy over time.
And you don't buy property, and we love working with your team as well. So I'll have look forward to having you back each month to have a chat about these things. And we've actually got an interesting topic we're going to talk about next month about how to avoid getting scammed. I'd like to have your thoughts on that one. Catch up with you next month, Stuart.
Thanks, Michael. Cheers.
Well, as always, Stuart had some great insights. And if you're a listener to this podcast, but you don't actually subscribe yet, my suggestion is just stop for a sec before we have the next couple of segments, and on whatever podcast app you're listening to this on, just subscribe or follow so that twice a week you get the regular updates of my and my guests' thoughts on housing, property markets, money and success. Oh, by the way, it'd be great if you leave a review as well. Now, in a moment, I'm going to share my regular mindset message with you. But before I do, I just want to remind you that Stuart Wemyss is going to be doing a special session for people at Wealth Retreat on the lessons he's learned on business and investing over the last 2 decades, over 20 years. If you are thinking about joining Wealth Retreat this year, please go to wealthretreat.com.au. And even if you're not thinking about it yet, go to wealthretreat.com.au and find out all about it and join me in a small group of people in my expert faculty where we can help you design the next 5 years of your life. Hey, don't count yourself out. It's a great event that we've been running for 18 years and we've already got a whole lot of great experts, faculty, but delegates coming as well. Many of them coming for the second, third and fourth time. So, as I said a moment ago, don't count yourself. Join us at Wealth Retreat, find out all about it and let me have a chat with you. But before we go on, I just want to remind you of what I just said with Stuart, that it seems that 2024 is going to be another good year for property. It's not often that all the property commentators and economists agree on something. And I guess in some ways that worries me because the economists have got a terrible track record for forecasting. But it gives me some reason to worry about their predictions. But that's as simple. The property markets will, as Stuart and I were mentioning to you, perform soundly this year. But they're also going to be fragmented. And you've probably heard me say before, most properties aren't investment-grade properties. In fact, I think about 4% of those currently on the market would be what I would consider investment grade. And that means many who are going to buy an investment in the next couple of years are going to sell up. In fact, 50% of purchasers are going to do that if history repeats itself. And those who stay in the game, many are going to find their properties underperform. So how do you beat the odds? You make the right decisions by getting the right advice. You've heard me talk about Metropole before. Why not let my team at Metropole help you plan to become the property investor you plan to become by putting a strategic plan together for you? Go to metropole.com.au and at least start off with a complimentary wealth discovery chat with one of my team so we can see how you can outperform the averages, make the right decisions, get the right advice. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to show you some happiness hacks. Look, if you've been following my blogs, especially the Rich Habits, Poor Habits ones, watched my videos with Tom Corley, or been listening to these podcasts, you know that your brain is like a computer operating system. It means that you can program it to choose what you're wanting to choose, to look for what you're looking for. The reticular activating system in your brain will search out for things, including happiness. But unfortunately, a lot of people are worriers and they're not as happy as they deserve to be. So I'd like to just share with you a couple of happiness hacks. Now, worrying about money, interestingly, is one of the biggest causes of unhappiness. But once you realize that no amount of money is going to make you happy, unless you suddenly shift your mindset into gratitude and abundance mode, you'll never be happy. We've heard those stories about those very rich people who are still miserable, haven't we? So my suggestion to you is to turn on that part of your brain that is going to be appreciative and grateful. So every morning, think of something that you're grateful for. At the end of each night before you go to sleep, think of the good things that have happened to you during the day, and your mind will be tuned and looking for more happiness. Another mindset hack is worrying is really a waste. It's a misuse of your imagination, because you're really just imagining it, aren't you? You're worrying about what could happen in the future. You're better off using your energy doing something you can control and accept what's going to happen, rather than worrying about things, because your expectations determine your experiences. Expect the best out of your day and you're going to usually get it. And interestingly, most of the things you worry about are not going to occur or won't be as bad as you expect them. In fact, most things that go wrong won't last. Ask yourself if whatever you're worrying about now, whatever went wrong, is still going to matter in a year's time. If the answer is no, then maybe it doesn't matter, or it doesn't matter that much today. Another mindset hack is being optimistic. You should be optimistic. You've heard me say before that optimists do much, much better than pessimists in this world. Now, being optimistic isn't actually being naive. It's not saying, no, nothing can go wrong. It's understanding that things can go wrong. But if you expect them to go right, you're going to find all the things that can go right, and you're going to be heading in the right direction. I think it's also important to understand that no matter how bad things seem at that moment in time, this time will pass and your life will be good again. So if you're having some challenges at the moment, remember the wise King Solomon had inscribed on his ring, "This too shall pass." It made sure that he wasn't too pessimistic when things were bad, but also that he wasn't overly optimistic when things were good. Understand then that this will pass. I think another mindset hack to make you happier is choose your battles wisely. Unless it's really worth fighting for, walk away for it and spare your energy. How often have you been cross with somebody, your life partner, your spouse, one of your kids? And the question is, are you going to leave them? Is this enough to break the relationship? And if it isn't, then is it really worth spending so much time being angry and cross? Just move on with it. So that's one of the other mind hacks, the happiness hack: choose your battles wisely. Another one I'd like to share with you is have the courage to say no to things that you don't want to do. That's going to allow you to say yes to things that you do want to do. Putting yourself first doesn't mean that you're putting everyone else last. Do the things that are right for you without doing the wrong things by anybody else. And the last thing I'd like to suggest is that regardless of what your experiences have been in the past, it's not too late to start backing yourself. Be courageous. Be courageous in your decision making. Stand by your choices and never look back. So, in summary, your brain is a computer operating system. Well, it's like a computer operating system, and you can program it to be happy or not. The choice is yours. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?